Hey, welcome back to Compounding Quietly. More investors are asking whether QQQ alone is still the right answer. Some are blending leverage and income in the same portfolio and calling it an upgrade. But an upgrade is only an upgrade if you understand exactly what you are changing. Let's get into it. When the market is moving with momentum, a certain kind of question starts to surface. What if the index alone is not enough? And right now, that question is showing up in two very different forms. One group is drawn to leveraged ETFs, products built to amplify the daily performance of the NASDAQ 100. The idea sounds appealing if the index returns 10%. A 2x product might return something closer to 20. The other group is drawn to covered call ETFs products, built to extract consistent monthly income from the same index, regardless of direction. Cash flow arriving in your account on a regular schedule, even during flat or uncertain markets. And somewhere between those two approaches, a specific combination has started appearing in investor conversations: 50% QLD and 50% QQQI, rebalanced at regular intervals, set against the alternative of simply holding QQQ and doing nothing else. That comparison sounds manageable at first, but the more you sit with it, the more it stops being a question about return profiles and starts being a question about what kind of investor you actually are. Every time a new combination strategy enters the conversation, most investors do one of three things. They chase the highest backtest number they can find. They choose the approach that sounds the most sophisticated. Or they reach for something that feels like a hedge, without clearly understanding what is being hedged or what is being given up in return. None of those responses is a real investment judgment. What matters is not which combination produced the best chart over a carefully chosen historical window. What matters is whether that structure actually fits the way you behave when markets become uncomfortable. That is the question this video is built around. Let's start with the simplest option, QQQ alone. QQQ tracks the NASDAQ 100 index. It holds the 100 largest non-financial companies listed on the NASDAQ. It does not try to do anything clever. It simply follows the index as precisely as it can. If the NASDAQ 100 rises 5% in a year, QQQ rises roughly 5%. If it falls 30%, QQQ falls roughly 30%. There is no income mechanism built into this structure, no leverage layer amplifying the daily moves, no option strategy running in the background, just the market doing what it does, reflected in a single transparent instrument. For a long-term investor, that transparency carries real weight. Not because plain index exposure always wins on a performance chart, but because it does not introduce variables you cannot fully understand or control. You know exactly what you own. You know why it moves the way it does. And that clarity is what allows you to hold through the periods that feel the most uncomfortable. Now let's look at QLD. QLD is a 2x leveraged ETF that tracks the same NASDAQ 100 index. On a day when QQQ rises 1%, QLD is designed to rise approximately 2%. On a day when QQQ falls 1%, QLD is designed to fall approximately 2%. That sounds like a clean doubling of the index return, but there is a structural reality that changes the picture meaningfully over time. QLD resets its leverage exposure every single trading day. In a trending market where the index moves consistently in one direction for a sustained period, QLD performs close to what the 2x label implies. In a volatile, directionless market where the index moves up and down, frequently without establishing a clear trend, QLD can lose real value, even when QQQ ends the same period roughly flat. This is called volatility decay. It is not a product flaw. It is simply how daily reset leverage functions mathematically across a sequence of mixed returns. Think about an index that rises 3% one day and falls 3% the next. QQQ ends that 2-day stretch, essentially where it started. QLD ends it slightly below its starting point, because gains and losses do not cancel each other out evenly when leverage resets daily. Over months and years of choppy, sideways markets, that drag builds up in a way that is invisible until you compare the charts. An investor in QLD needs to understand and accept that feature, not as a rare exception, but as a regular characteristic of the strategy. Now let's look at QQQI. QQQI is a covered call ETF built around the NASDAQ 100. It generates income by systematically selling call options on the index in exchange for receiving that premium income, typically distributed to investors on a monthly basis. It gives up a portion of the upside when the market rises sharply beyond the strike prices of those options. In a strong bull market, QQQI will trail QQQ noticeably in total return. In a flat or slowly declining market, the income from those options can partially soften the impact of limited price appreciation. The monthly distribution is real. Investors receive actual cash on a consistent schedule, but that income represents a structural trade-off, and that trade-off is most visible in the years when the Nasdaq rallies forcefully, and QQQI captures only part of it. Coming back to the question this video started with, is a 50-50 blend of QLD and QQQI actually better than holding QQQ? That depends entirely on what you mean by better. If you commit to rebalancing regularly, say, every quarter, you are agreeing to a specific and demanding discipline. You sell whichever leg has grown larger and buy back whichever has fallen behind. In theory, that creates a useful mechanical rhythm. You trim QLD when it has run and add to it when it is pulled back. You keep QQQI from shrinking as a share of the portfolio during strong growth periods. In practice, it requires you to add money to QLD when it has just lost a significant portion of its value, and to reduce it precisely when it has performed well, and you feel reluctant to sell. That sounds rational when described in calm language. It becomes genuinely difficult to execute when QLD is down 40%. The income from QQQI is lower than expected, and the market is offering no clear signal about what comes next. The investors who manage combination strategies like this over time are not the ones with the most elegant backtest. They are the ones who understood what each component does deeply enough that nothing in the portfolio's behavior came as a surprise. QQQ is not the exciting answer here. It does not pay you every month. It does not double your return when the market runs. But it also does not introduce compounding, drag, income caps from options, or the recurring psychological weight of quarterly rebalancing decisions. The question was never which strategy looks better on paper. The question is, which one you can genuinely hold through long, flat stretches, through sharp drawdowns, through the years, when nothing seems to be working, without convincing yourself after the fact that you made a mistake. Some investors genuinely benefit from a combination approach. The income from QQQI gives them something tangible to observe during slow markets. The leverage in QLD gives them the growth orientation they want from the Nasdaq over time. And the rebalancing discipline keeps the portfolio from drifting too heavily in one direction. But that combination only works cleanly when you understand each piece before you put them together. Not after the first drawdown, when you are searching for an explanation, before when the market is still calm, and you have the space to think clearly about what you are actually building. Investing is not about finding the structure that wins the most arguments. It is about finding the structure you can stay inside. And if that structure turns out to be QQQ with no leverage, no income mechanism, no options overlay, and no rebalancing schedule, that is not the obvious answer. It is the honest one. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.